Hello everyone, Suresh KP from myinvestmenttraders.com. Today we are going to review ITI Banking and PSU Debt Fund. Can we expect higher returns compared to bank fixed deposits? Okay. First, before we get into the NFO information, let us talk about what exactly are these banking and PSU debt funds. So if you see banking and PSU debt funds are mutual funds, generally they invest 80% in debt instruments like your debentures, bonds, and certificate of deposits of banks and PSUs. So these funds generally have high liquidity and low average maturity. So these are best suitable for risk averse investors. Means if you are moderate to low risk investor, then you can invest in these banking and PSU debt funds. Now let us get into information, NFO information. The investment objective, the way we indicated, it invests in debt instruments of banking and PSU things. So all scheduled commercial banks, public sector undertakings, public financial institutions, municipal bonds, everywhere this fund is going to invest. And this fund is co-managed in a co-fund manager model. So the co-managed by Mr. Milan Modi and Mr. George Heba Joseph. Now, if you come to the NFO issue details, the scheme is going to open on 5th October. It's going to close on 19th October. And again, the scheme is going to reopen for further purchase and sale on 30th October. And like any other mutual fund scheme, this is available in direct, regular, and growth and dividend options. If you want to invest in this NFO, you can invest a minimum lump sum investment of 5,000 rupees. And you want to go for SIP, you can invest 500 rupees per month for 6 months. And there is no entry or exit load. The risk meter is moderately low risk, and the expense ratio is 2%. And this fund is benchmarked to CRISIL banking and PSU debt fund. Now let us talk about the allocation pattern in this fund. So the way we indicated, it invests 80 to 100% in debt instruments. When we say debt instruments of scheduled commercial bank, PSUs, public financial institutions. So the risk profile here is low to medium. It would invest up to 20% in debt instruments and money market instruments issued by other entities. So here the risk profile is low to medium. It also invests up to 10% in REITs and INVITs. The risk profile in the segment is high, medium to high. Now let us talk about some of the reasons why we can invest in this mutual fund. This fund invests in debt instruments of banking and PSU enterprises. So these funds are considered safer compared to corporate bond funds, where generally the corporate bond funds invest in corporate debt instruments, which are very, very high risk. Now, this fund also aims to invest in short to medium term, example 2 to 5 years. So if your investment objective is to invest for 2 to 5 years, then you can invest in this fund. Since it invests in banking and PSU debt instruments, it's actually there is a high liquidity here. For example, if you go for corporate risk funds, they're actually investing in corporate debt instruments, and they are very, very high risk. We're already seeing that in the Franklin debt instruments, debt funds, where there's a delay in getting funds from the wherever they have invested, and they have wind up, and now slowly they are getting their money back. So that risk is generally there in the corporate risk corporate bond funds, whereas in this banking and PSU debt funds there is no such risk. If you see, banking and PSU debt funds actually perform well, which has given the extremely very good return compared to your corporate bond funds or your dynamic bond funds, or you talk about medium to long term duration funds. Let us talk about some of the risk factors here. So these funds generally invest in debt instruments. So there is an interest rate risk. Means if your interest rate is increasing, the yield is going to fall, and vice versa. Though this fund is going to invest in government enterprise and PSU debts, generally they are zero risk. But there is a great risk in the commercial banks. Example, if you see Lakshmi Vilas Bank, recently there is a crisis going on there, and earlier we could see S Bank. So don't think like your banks are 100% safe. There could be element of risk, though these are governed by RBI. Now this fund also invests in REITs and INVITs, which are generally considered as a high risk. So one can refer complete risk factors before investing in this fund. Now let us talk about the performance of the existing banking and PSU debt funds. If you see, these funds have done extremely well. If you see the 5 years performance of all these PSU debt funds, 8.8% to 9.1%. This is an excellent thing because if you see they're all your moderate to low risk, but still they're able to get that superior performance. Don't go with a 1 year returns. They are ranging between 9 to I could say even 12.9%. But don't expect that kind of returns. Expect a reasonable 7 to 9% returns. One can definitely get from these mutual funds. Now let us talk about the conclusion. ITI Banking and PSU Debt Fund invest in debt instruments of banking and PSU enterprises. So while the banking has a little element of risk, otherwise the investment in PSU enterprise is almost zero risk. In the coming quarters and coming years, we expect that interest rates are expected to further fall. So the bond yield is going to increase. So the returns from banking and PSU debt funds are definitely going to be on the higher side. If you are a moderate risk taker and if you're expecting say 7 to 9%, 10%, then you can consider investing in this fund. Alternatively, if you don't want to test in new funds, we don't know how this fund is going to perform, then you can invest in some of the top performing banking and PSU debt funds, which we listed in the above the previous slide. If you have any queries, you can reach out to me, Suresh at myinvestmentideas.com, and keep visiting myinvestmentideas.com. Thank you.